Now we're going to talk about closing entries. So at the end of an accounting period, we need to be able to close down what we call the temporary accounts. Your temporary accounts are revenues, expenses, and dividends. These are the accounts that indicate what happened over the specific accounting period. We close them out by transferring their balances to the permanent stockholders' equity account, retained earnings. Your temporary accounts are any revenue account, any expense account, and any dividend account. Your permanent accounts are your asset accounts, your liability accounts, and your basic stockholders' equity accounts, such as common stock and retained earnings. They're not closed. They continue to hold running balances. Temporary accounts do not. They're reflective for operations and transactions over a specific period of time only. To do so, we close the revenue accounts to the income summary account. We close the expense accounts to the income summary account. And then we close dividends to the retained earnings account. We'll close the income summary account to retained earnings. And when we have done this, we will have created a zero balance in each of those temporary accounts. These accounts have then been reset and are ready to accumulate data for the next accounting period. If you look at an income statement, there's one in illustration 427 in your book. The top of it says the date is for the month ending October 31st, 2017. How can you be sure that the revenues and expenses reported on this income statement are just for that period? Closing entries transfer the temporary account balances to stockholders' equity and reduce the balance in the temporary accounts to zero. This effectively resets them and brings them ready to accumulate data for the next accounting period. Let's take a look at how we do this. One of the reasons we use the income summary account is because we're going to engage in a lot of entries. If we were to close every single individual account to just retained earnings, we would create a lot of entries and data in the retained earnings account, which can create some confusion. So what we do is we use this temporary account. It only exists during the process of closing, called the income summary account. You begin with your revenues. And for each revenue you have, you will debit it for its balance. So when we debit a revenue, we reduce it. And then we credit that amount to the income summary account with a notation to close the revenue account. We then go to all of the expense accounts. We typically do this in one entry. We'll do all the expenses together. We credit each of those accounts for their balance, and then we will debit the income summary account for the total. At this point, effectively, in your income summary account, the balance should be equal to your net income. We then debit the income summary account for that amount, since we're assuming it has a net income because revenues were in excess of expenses. And we credit that over to retained earnings. We debit retained earnings for any amounts in the dividend account and credit the dividend account. And credit the dividend account. By engaging in all these entries, we'll effectively bring everything to a zero. As you can see here, this is the T account transactions of closing the accounts. When salaries and wages expenses have equal debits and credits, then the balance is zero. Same for supplies expense and any other account in the chart of accounts. Take a moment to peruse this in light of the last slide. Now, after the closing entries have been journalized and posted, we're going to create a post-closing trial balance. The purpose of this post-closing trial balance is to prove the equality of the permanent account balances that a company carries forward into the next accounting period and confirm that all the temporary accounts have zero balances. Here we have a nice little slide to remind you of all the steps regarding the accounting cycle, from the first of analyzing business transactions all the way through to preparing the post-closing trial balance, which happens at the end of an accounting cycle and closes out the temporary accounts and resets them to accumulate data for the next accounting period. Let's just take a quick moment to look at a few more of these refresher slides. It's important not to necessarily just memorize the steps in the accounting cycle. What you need to do is you need to think about what has to be done logistically and in order, and to make sure that the transactions are ultimately reported in the financial statements. You start off by analyzing the transactions. What is its effect on the accounting equation? Once you have a good grasp on that, you move forward to journalizing the transaction in the book of original entry or the general journal. Remember, you start with debits, and they're the first lines. And then the credit lines are indented, and there is a notation of what the journal entry is representing. We transfer each of those amounts to the appropriate ledger accounts, and we prepare a trial balance from those ledger accounts. The trial balance confirms the equality of debits and credits and provides you with an opportunity to review everything in one location. We then move forward and through time towards the end, at the end of the accounting period, we'll journalize and post appropriate adjusting journal entries for deferrals and accruals, recognizing things such as prepaid expenses that have expired, unearned revenues. Once those have been posted, we prepare an adjusted trial balance. The adjusted trial balance continues to prove the equality and gives you an opportunity to look to ensure that all of your adjusting entries had the effect you were expecting. No one's perfect, and every now and then someone will enter an adjusting entry backwards. When that happens, that may become apparent in an adjusted trial balance because you will have a non-normal balance in an account. We use that adjusted trial balance and create the financial statements. We create them in this order of income statement, retained earnings, and then balance sheet. After the financial statements have been made, we journalize and post the closing entries, closing out the temporary accounts of revenues and expenses to the income summary account, and then closing the income summary account and the dividends account to the retained earnings account. To ensure that we have completed all of our closing entries, and as a last check, we prepare a post-closing trial balance.